I'm Chris Preston.
I'm Brad Summerlin.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network. Uh, Brad, I don't have anything, that we really need to talk about at the top outside of investing, other than my Bills. It's self-serving, but my Bills, pulling a rabbit out of a hat last week against the Ravens, they were like 15-16 down with like 6 or 7 minutes to go. I missed the whole thing because it's just, this is where I envy you being on West Coast times. You can watch an entire night game and it's over at what, like 8 your time, 8:30, something like that.
I don't remember. I turned it off. I was watching it and it's like, all right, this one got away from Ravens look better than I thought they would. Bills look worse. And then I was just sort of saw it on the box score live as they came back.
Yeah.
I don't know. This feels like the year where or the next year sort of sequentially where I'm just not as into football and it seems to be waning. I don't know if it's
Mine's
an
been waiting
age
for,
thing.
yeah. I think I started waned. And uh, I mean, I'd say it's actually been higher in recent years because like I've said, like I'm mostly just into the Bills and that's it. So this last few years have been good. And the early 90s were good. And that's pretty much it.
I
But
mean,
yeah,
this
good brand.
year this year's like the first year where I don't have any kind of packages. Like I just bought a rabbit ear antenna to just get whatever the local
Oh, yeah.
broadcast is instead of
Yeah.
paying for services and stuff.
Yeah.
But then you turn on the first game, the Cowboys Eagles game, and it's like, okay, extensive penalty, somebody gets ejected, and there's an injury on the first before even the first snap. And it's like, okay, yeah, this is why my interest has been declining.
Right. Oh, I
NFL
thought you were
didn't
going to
get
say
off to the
going
right
up.
start. Yep.
Yeah. Okay. Well, let's get to investing then. Tell people what we're going to talk about today.
Big news this week, obviously, inflation numbers coming in lighter than expected and seemingly signaling a rate cut. So we're going to talk about the Fed too. Oracle popped on an announcement. I have things to say about that. Klarna IPO, buy now, pay later company, but they made a lot of headlines for how much they were integrating or trying to integrate AI. And then we're going to talk about whether winning matters for sports teams, specifically for the stocks of publicly traded companies that own sports teams. But before we get into that, as always, Chris, you are up to defend a take. Your take this week: rate cuts will push the S&P over 7,000 by the end of the year. You have 90 seconds. You may begin.
Yeah. So to get there, it would be about roughly 6% from here, which doesn't seem crazy. S&P, this is the S&P I'm talking about, of course. S&P's up around 12% for the year. You know, we, I know this fully aware that a few months ago we sat here and said, no, we thought the S&P would end around 6,000 for the year, give or take. And by the way, so did most Wall Street firms. That was the consensus. Well, what has changed? What's changed is so far a couple things. Tariffs had a have not put the dent in the economy the way that people thought, and also the Trump administration has backed away from tariffs in certain cases, in a lot of cases, the words less harmful than people initially feared. That's one. Two, the Fed, mostly because of real weakness in the jobs market, which we'll get to, is going to cut rates probably faster than we thought. We thought one or two 25 basis point cuts for the end of the year, probably starting in September, which is likely to happen next week. I think it'll be more like three. Some people think it might even be a full 100 basis points. So I think with a more favorable Fed, a less harmful tariff picture, an economy still hanging in there, and AI still crushing it, as we'll also talk about later, is a recipe for stocks being higher than we thought. I think 7,000 year end S&P.
Within 2 seconds, hit the post on
Ooh,
that one. Good
see, I'm
job.
getting good. I'm good at getting good at this.
Yeah, I don't know. There was a quote from
I
a
know you don't think it'll get to 7,000.
I
That's part of why I
look,
said
I'm not going to step in front of a train, right? Like that is what this market is doing right now. Like yes, I tend to be bearish and yes, I see a ton of overvaluation, but the market's a freight train right now. I'm not going to say no, there's no way it goes up 6.5% in the next 3.5 months. That um like do I have concerns about it? Yeah, obviously. And I mean Oracle I think will be a good example for that when we get there. But yeah, I don't. I don't know. I did see some commentary that there are some analysts saying that the Fed cuts are going to be a sell the news event, right? I mean, the market is has been running higher on
Yeah.
expectations of rate cuts.
That hasn't been the
Not,
case, though. That's part of my calculus. Yeah, I should have mentioned the last few times that they have started cutting rates, including last year, stocks went in around all-time highs when they started cutting rates on almost the exact same day last year that they are presumed to this year. This year, I think it's September 17th, last year, 18th. Stocks were up 7% from that point until the end of the year. So 3.5 months. 7% would get us there. Um, and, when they cut rates by a lot in March 2020, that's what turned the market around. And when they did it in 2019, no one talks about this. They cut by 75 basis points. Market also raced, and this is over the course of like 3.5 months, also raced to new highs. So rate cutting, I mean, maybe it'll be a sell the news kind of a thing in the day or two after it happens, especially if it's 25 basis points and not 50. I could definitely see that. But I think rate cuts are a good thing for the market. And it's not just anticipation of rate cuts.
well, so leading into this because it is the Fed is on our list.
Yeah.
I was gonna
Let's just roll into it.
yeah.
Yeah.
So I was gonna write something about this, but it gets a little bit muddy. Historically, you don't want the Fed cutting rates by 50 basis points. That's like a rescue move. That's not a
Right.
hey,
Yeah.
the economy is booming. Let's slash interest rates by 50 basis points. But the problem is like 2019 and 2024 sort of muddy it. Outside of those two periods, every 50 basis point cut has been within a year of a recession, either in front of it or at the end of it. So like it
Yeah.
gets too muddy to really draw any kind of concrete conclusions. But if the economy is humming and inflation is under control and everything is hunky dory, why cut rates by 50 basis points?
Yeah. Yeah.
Like that's the
It's just it would feel more desperate. It feels like people, because they've looked at these jobs numbers, are saying like, oh, maybe it'll be 50 basis points. And I could see them being disappointed again for like a day or two, but then realizing, they still cut rates and they're likely to cut rates more. And yeah, like you said, 50 basis points. When it happened last year, it was different. The rates were a full percentage point higher last year when they started to cut. And it had been years since they'd cut. Now it's been a year. Rates are 100, 1% lower than they were, and or 100 basis points lower than they were. And yeah, the economy, the jobs thing is the only, red flag, and it is an increasing yellow to red flag, but other aspects of the economy are hanging in there better than most people thought. So I think uh, I think it'll be 25, and I think we'll get three 25 basis point cuts the rest of the year.
right now the CME FedWatch is pricing 91%, or as of the close yesterday, 91% chance of a 25 basis point cut and a
Yeah,
9% chance of a 5% cut. Um, the question for me is like, is this a repeat of last year where the market rallies off it, or is it something to worry about? Like I had been talking about where the Fed doesn't normally cut 50 basis points because the economy is great. But one of the other things that I've seen a lot of headlines about is 3% just like the new normal for inflation? You and I had talked about that, 2, 3 years ago, where it's like, okay, inflation's into the twos. That should be enough to prompt some Fed
yeah,
cuts.
yeah.
So
Which
are
we
we
were right
just
about.
now, yeah, are we just now like, are we re-rated to where 3% inflation is just acceptable? And that, I mean, it's not the Fed could come out and change their mandate and say, hey, we're, I mean, I don't expect it this September, but there's nothing to prevent them from saying 3% inflation is our new baseline. But they're behaving
Yeah,
that way.
yeah, you're right. I could see this being similar to last year, where they cut for a few months through the end of the year, but then inflation either continues to creep up or hangs right where it is, and then they're like, all right, we're going to pull in the reins again. Um, Yeah, it does seem like they're fine with 3% inflation. Like I wonder if they're just like, well, I guess, it's not as bad as 9%, 8%, 7% like it was a few years ago, and they're fine with it. Maybe there's some pressure from the White House that, makes it forces them to be okay with 3%. I don't know. Um,
So they do have some room to sort of scribble in the margins. Because right now the Fed funds rate at 4.25 to 4.5 is still almost 1.5% over the sort of running inflation rate. Core CPI is up is what 3.1% annually right now.
mhm,
If the Fed, where I think alarm bells start ringing is if the Fed cuts the Fed funds rate below the CPI inflation rate, because then just by sort of parking cash with the Fed, you are losing purchasing power. Like
right.
that's actually like a deflationary environment. There, so I guess transitioning then to inflation, PPI came in down 0.1% versus
Mhm.
a 0.3% expectation. Core was up 0.3%. Services prices pulled down the average. So there is some evidence that companies are sort of continuing to eat cost overruns coming from the tariffs.
Yeah.
I don't know. I wouldn't be cutting rates now. Inflation is still running hot, but if this is the new baseline, this is the new baseline.
I think the jobs thing is what, and the
Yep.
latest bit of news all but cinched it. I think it was seems like it was fairly cinched, but what was it, 900,000? If they went going back a year, there's 900,000 fewer jobs, or, you know, 900,000 plus fewer jobs than initially calculated added to the economy. And that's a lot.
Yeah,
Um,
that
So,
is
and
huge.
after the revision, downward revisions till in May and June to what, like, was like 15 or 15,000, 20,000, something like that. Um, Not a whole lot of jobs being added right now. Uh,
And
uh, and I think that is almost forcing the Fed's hand to do at least something, even if it's temporary.
well, then just on a week to week basis, 263,000 unemployment claims this week was reported this week. Was above 235,000 expected. So uh, it's the K-shaped economy thing, right? The market reflects the economy, but the stock market is not the economy.
Hmm.
Um, but I think you're right. The jobs thing, obviously, Powell came out and said it at Jackson Hole, where the jobs picture has made it the dominant of their dual mandate, and that's the right approach to have, right? Like you save jobs, you protect people to the extent that the Fed can do so, even if it's at the cost of higher inflation, and that
Yeah.
might be, I think, part of the calculus behind it.
Yeah. So, I mean, you've said all along, I think we both said all along, we thought, well, no, I guess I thought two 25 basis point cuts by years end. I think you changed to one at one point. What are you thinking now? Maybe I have that wrong.
I, I I think they're I think they're probably I think it is a safe assumption that there are two cuts this year. Um,
Yeah. I think 2 to 3 is the question, for me. I think I'm starting to shift towards 3. Um, but maybe I'm looking at that the Fed watch tool way too much.
yeah,
Um,
I'm
which
I'm
is
not
often wrong. So,
yes.
yeah.
It Everybody's wrong about how often the Fed's going to cut rates. Citi and JP Morgan were saying 6 cuts at the beginning of this year.
Was that
Everybody
this
was
year or was that last year? I can't remember.
I think at the end of last year, coming into 25, they were saying 6, but maybe it was last year. Either
Yeah.
way, they are overestimating the propensity. Um, I'm not going to begrudge the Fed making adjustments to the Fed funds rate as long as it stays above inflation. But when we get to 100 basis points of cut, if they keep cutting below that, that is when I become very concerned about the state of the economy as a whole.
Yeah. We're
But
now at, speaking of the FedWatch tool, the CME group FedWatch tool, if for those interested, 76.5% now think there'll be 3 cuts by year's end. Uh, So that's I'm sure that's influencing me. In the past we've usually zagged from this, the Fed watch expectations, but I don't know. Yeah, two or three. It'll be interesting. It'll be interesting to see if it's only two, if that has a negative impact on stocks, given that there are expectations of three now. Um, but again, I still think two or three. I think rate cuts are generally good for stocks, and that's why 7,000 by year's end. Oh, one thing I wanted to mention as part of that, I've been saying all along that I thought there'd be a 5% pullback at least in September. That hasn't happened. So we're starting from a higher point than I thought we would be. Now, September's only not even halfway through, but the VIX is really low. There doesn't seem to be any, especially with the Fed about to start cutting rates, there doesn't seem to be any sign that there's going to be a usual September pullback. Stocks are up so far this month. So that's been a bit of a surprise to me. So that's part of my calculus, I guess.
Yeah, it's I mean it's definitely fair.
Yeah.
I think part of the question is you look at these sky high valuations and you
Yeah.
look at the low VIX and it's like, okay, well, are most investors just disregarding market movement and just like reinvesting their or investing their 401ks and disregarding it? The rise of ETFs, there are now more ETFs than publicly traded stocks, and
Mhm.
passive investing, like has that introduced a structural change to the way that the market operates? Right? Like there's less actively managed funds, there's less active investors. Is passive investing just making a lot of the concerns that we would have had for the last 50 years a little bit more irrelevant? I mean, like this is something like value investing, right? Value investing was popular and viable, and other than finding like a few extremely oversold outliers, it's been underperforming for
Over a decade. 15
yeah,
years? 15?
something like that. Yeah. I
Yeah.
mean, essentially since the
Recession. Great recession, basically,
yeah,
right?
and then once we rolled out QE, it's
Yeah.
been sort of cast to the side. And you can never say this time is different because that is always the trigger for reversion to the mean, where
Hmm.
then like that's when the market sells off. That's when you run into the correction or whatever. Uh, but is there a structural change operating under the surface? Maybe. I can't write it off entirely. And if that's the
Yep.
case, then we need to adapt a little bit and maybe underweight some of the impulses that long-term investors have had, which is like it's the major league thing where it's, hey, it's no good, it's too high, right? Like that's how
One of
the
my favorite
market is.
movies.
That's how the market's operating right
Yeah.
now, or that's at least how like the bearish perspective is. No, it's no good, it's too high. It's like, well, it's too high if people care about valuations. It's not too high if the only way you're getting exposure to assets is buying SPY and buying in your 401k.
Yeah. Yeah. I do think part of this will lead right into our next topic. AI is the tailwind of AI is real. I mean, not that that's breaking news, but I think it has more of a lasting impact on the market in terms of, being a catalyst for the market than, probably you and I have talked about, and maybe others have talked about. AI has been the catalyst over the last 2.5 years. So let's get into the latest evidence of that. Oracle reported earnings earlier this week, Tuesday, and it's some of the biggest, in Mike Santolo's words, some of the biggest he's ever seen. So cloud infrastructure business, our revenues up 55%, while performance obligations more than quadrupled to $455 billion. Thinking, and the management thinks it'll top 500 billion in the next few months. The cloud infrastructure business revenue growth accelerating to 77% this fiscal year, up to $18 billion, and then expand to $73 billion in 2 years, $144 billion 2 years after that. And by comparison, as Mike wrote, as Oracle as a whole had revenues of around 50 billion in the prior 12 months. Those are big numbers. And that looks like the vast majority of the new business inked in the last quarter came from OpenAI. So there's another case of AI really moving the needle for a company. We know what it's done to NVIDIA and Palantir and others. All the Mag 7 or most of the Mag 7 and big tech, and Oracle is the latest beneficiary. To me, this just screams that it's sort of almost like a trickle down effect of AI. The AI popularity is now not that Oracle is certainly not a small company, but it's not as it's not as big a name as the ones I just mentioned, and now it's getting reaping the benefits too.
Okay. I think you and I are going to be on really opposite sides of this.
Really?
Yeah. So the 300 billion from OpenAI is, I'm going to choose my words carefully here, an exuberant overvaluation.
Oh, I'm
Uh,
sure that's
um,
true.
so OpenAI made $4 billion in revenue last year. This year they're tripling it to 13 billion. They're doing they authorized a secondary share sale of 10.3 billion just a couple of days ago. They authorized it. So it's still private, but secondary sale that values the entire company at $500 billion. Oracle is reporting to investors that their remaining performance obligations, they're going to pull $300 billion from OpenAI in the next 5 years. That money isn't coming from anywhere. It doesn't exist.
Hmm.
OpenAI does not generate enough revenue to spend $300 billion with Oracle over the next 5 years. It cannot happen unless OpenAI essentially quadruples their revenue every year for the next 5 years. Uh, Coincidentally, Oracle, which was up 36% after announcing this, had their biggest one-day move since the dot-com bubble.
Hmm.
They're also down 15% in the last 2 days. These numbers are irrelevant. Um, if you have Oracle, congratulations on the win. A fantastic move. I know a lot of people are bullish on it. I'm not saying you can't be bullish on Oracle or that you shouldn't be, but do not bake the RPOs for OpenAI into your expectations for what the stock's going to do. There is no way OpenAI loses money every year. They're going to spend 13 billion this year to lose 2 to 5 billion. I don't know exactly where their margins are right now. They're private. They don't have to disclose it publicly. They have no source for this money. They don't have any way to pay Oracle $300 billion in the next 5 years. My suspicion is that this is a way for the hyperscalers, your Metas, Googles, Microsofts, to back off on new CapEx spending to build their own data centers via a contractual agreement with Oracle, right? So they, instead of Meta and Microsoft spending $500 billion in the next 3 years, they don't want to take the risk of more data center build out. They are just saying, hey, OpenAI, we're going to use you for this capacity. And OpenAI is saying, okay, well, if they're going to use me for this capacity, hey, Oracle, we're going to rely on you to do the build out. Um, this is that is an insane thing for Oracle to report. It's something that we've talked about before. Like, if the AI thing works, if we hit artificial general intelligence and AI is everywhere and people actually start spending money on AI, which as of right now, the hyperscalers have spent close to $500 billion on data center build out in exchange for about $35 billion in revenue. If that number flips, if everybody on the planet starts spending money on AI, on artificial intelligence. There's a path for this to be true. But given the conditions of the market right now, given how little revenue is actually coming in for these all these AI tools that are so indispensable, there is no way this happens.
Yeah, I think I agree with a lot of what you're saying. I mean, I can't remember where I saw it, but like the number of companies that have actually turned a profit from AI is short. Um, but
MIT study, I think, is what you're.
whose study?
So MIT did a study
Yeah, I think
about
that
AI
would, yeah,
implementation.
that is what it,
There's a lot of conflicting headlines about that, but yes, there isn't right now. There is not profitability from
right.
these AI
And
tools.
yet, look at what it's done for companies, stock prices, the market as a whole. I'm not saying that, I didn't say that the bubble might not might the bubble could burst the way that the dot-com bubble burst. Oracle's a much bigger company. It's $833 billion market cap, a much bigger company than, some of the smaller players in the dot-com bubble. Um, but I guess my point was more, this is just the latest evidence of you say anything AI and people will believe it. You
Yeah,
I mean, yes, we are seeing a bit of a, you know, return to reality for Oracle's stock price the last couple of days, but that's pretty common after a move after this. I mean, maybe this is probably more forceful than a lot of them, but I don't know. Until that bubble, you know, tangibly bursts for Oracle and others, I think AI will continue to act like a tailwind and will keep delivering giant pops on earnings for companies like Oracle for the foreseeable future.
yeah. I don't. I'm not going to disagree with that. Like I said, I mean, like I said up top, I'm not stepping in front of this train,
Yeah.
right? Like I'm not calling a top on anything. Um,
I think the AI bubble will burst at some point, but that could be like 5 years down the line, 3 to 5 years down the line.
I mean, we're 3 years into the rollout of like Chat GPT and large language model tools, and some of them are good and valuable, like protein folding. That's an innovative technology that people have access to now that they didn't 5 years ago.
Yeah.
Um, and there's probably marginal productivity improvement using like instead of having one customer service rep, you now have three because
Hmm.
you've got an automated chat and it only filters people to you, or it only filters service interactions to you if it gets outside of the scope of like what it needs to do. Like if you're calling your dentist and the dentist just to get the address, like the AI can do that. Um,
Yeah.
but right now, right now the money is being spent by the hyperscalers who are still like your Googles and your Metas. They are making money hand over fist still. Um, they don't have a better place to put it than AI, and there doesn't. I mean, once we hit like the cloud compute revolution, there don't seem to be any blue oceans and like any new undiscovered territories for these companies to expand into. So they're doubling down. I mean, it's not dissimilar from what we saw with the metaverse.
Yeah.
Obviously, AI proliferated way more than the metaverse did. That was an expensive failure, especially for Meta, a company that renamed itself for the metaverse. Um,
Yeah.
if he, I'm gonna go out on a little bit of a limb. If
Please do.
OpenAI ever goes public, that will be what pops the AI bubble
Ooh, I like that.
because that is when they're going to have to start reporting figures. They're privately held right now. Microsoft doesn't segregate out their AI revenues. Um, OpenAI is sort of a black box because people are funneling money into it and then they're making deals with other publicly traded companies. The RPOs, I mean, look, the contract, which I have not seen, between OpenAI and Oracle could be rock solid, set in stone. OpenAI has to spend every penny of that 300 billion. I don't know. I would presume that it is not that set in stone. But if and when OpenAI goes public and actually has to open their books, that'll be the needle that pops the bubble.
That's a good take. Um, yeah, we'll see. I'm gonna give a comparison that's right up the alley of our producer Madison. AI is like the Kardashians. It's ever present now. Everyone knows AI is shorthand for artificial intelligence. Like it is making a lot of people a lot of money on the surface, at least, but no one knows why it became. It's like Kardashians, no one knows why they became famous. They are famous for being famous. AI has become famous for being famous, even though, according to this report, now, maybe there's conflicting reports, this MIT report that you referenced, um, that it actually isn't making people money.
That
Yeah. Maybe it will happen, and I think that probably will come from consolidation. Everything comes from consolidation and bubble bursting and the smaller players being pushed to the side and all the bigger players, the Nvidias, the Palantirs maybe, but certainly big tech, reaping all the benefits of it. But yeah, I think its power in the market is undeniable, but it may be a hollow or a much more hollow power than people think.
Well, I think the Kardashians analogy is apt because it made the Kardashians a lot of money, but
Yes.
nobody else is benefiting from it.
Right.
And
Right.
that I think that's how the sort of AI bubble, I guess if we're calling it a bubble, we're calling it a bubble. That's how the AI bubble is playing out. It's making a lot of money for the companies being inflated by the bubble, but it's not
Yeah.
trickling down anywhere. And I think that that's a good sort of transition to the Klarna IPO.
And by the way, I think everyone should try and ride the AI train as long as they can. I don't think either of us are forecasting the bubble to burst in the next 12 months. I think we both think it will burst eventually, but profit from it while you can.
I will not I won't go so far as to say it doesn't pop in the next 12 months.
Really?
I think
Wow.
it could. Right now, OpenAI is trying to so they were formed as a nonprofit and they are trying to reorganize as a for-profit company that California is fighting back against, as is Delaware.
Yeah.
It's like legally they can't just become a for-profit company. Now, given the sort of judicial oversight and regulatory oversight picture that is in place right now, somebody will probably just let that happen. I don't anticipate anybody pushing back too hard. I don't know how high it'll have to get escalated, maybe go to the Supreme Court or whatever. But I think at some point they do become a private or a publicly traded company that is a for-profit business. And they're working on that now. So I think the timeline could be within a year. Um, but
Yeah.
have
Speaking
stops.
of IPOs, though,
Yeah. So
yeah,
Klarna is a buy now, pay later company. They got a lot of headlines from their CEO who said um, they have AI doing the work of 700 employees, and they made repeated claims about how core artificial intelligence is to their business model. Um, they had to walk that back and acknowledge that they were hiring humans again. The company itself IPO'd, priced at 40, opened at about $50 a share just a couple of days ago. As of the close yesterday, it was back down to 42.75.
yeah.
So it priced appropriately. It ran up a little bit and then it drew down. So not lackluster, not a bad performance. Also didn't explode like a company like Figma did or CoreWeave or Circle did. The thing that the takeaway that I had from it is that the down the food chain stories, the AI focused companies, they are not benefiting from this. The market has bid up the hyperscalers. The market it has now moved down to the next level to the immediate second tier companies like your Oracles, um, like your Cornings, nuclear energy, like all these companies that sort of build inputs into the data center build out. All those companies are benefiting, but the companies that are ostensibly one step further removed, that are actually trying to implement AI into their business models, the market is when they come public, like Klarna did or when they trade, the market is just giving a shrug of their shoulders and saying, we don't really care. Um,
You know who
I will.
cares?
Who's
Kathy
that?
Wood. She invested $8 million, and Kathy Wood is nothing if not a meme. So that tells you right there. She's famously on the wrong sides of trades lately. So the fact that she did that and then it immediately pulled back is on brand. But anyway, go ahead.
So the other thing about Klarna, they are a buy now, pay later company in that K-shaped economy where the kinds of people that will use a buy now, pay later service are struggling more.
Yep.
Subprime auto loan are really weak right now. Credit card balances are rising, like all that stuff that's affecting actual people in their real lives.
Mhm.
They are struggling. So you could you could simply write off the Klarna IPO as reflecting more closely what the actual like business is rather than the market's receptiveness to a company that's actually trying to use AI as part of its business model.
Mhm.
So I don't want to like discount that element, but we the enthusiasm has not made it all the way down the food chain to the companies that are actually trying to use AI on a day-to-day basis.
Yeah. I wonder if when it gets there, that'll be that along with, I mean, I like your open AI going public being the thing that pops at theory, but I wonder if that'll be the tell that we're nearing a bubble. Maybe that doesn't happen. I don't know. And I think this also speaks to, the IPO market has still been, I know it's picked up from what it was a couple years ago, but it's still been kind of lukewarm the last few
Yeah,
years, which is reflective of, a market in which there's such a short list of haves versus the have-nots, expanding list of haves, but not, the equal weight is still only up 8% this year. It still trails as it has for the last few years. And with what's the tally on money in or cash in money market funds now? It's like
it
7
it was
trillion.
over 7 trillion the last
Yeah.
time I looked at it.
Yeah. So there's still a lot of non-believers out there unless, you're talking about a handful of AI big tech type stocks and gold now.
It
Uh,
is 7.48 trillion.
yeah, that just keeps
Um,
rising. Um, I
well, and
guess
if
the outside shadow will get to your 8 trillion number that you'd said for the beginning of the year, but
so if the Fed does cut rates below the inflation rate, that money has to go somewhere else.
right.
That I like if you're looking for a catalyst that gets it off the sideline, um, meaning it's money that's like dry powder and not being preserved for because people are concerned about the business environment or whatever. Um, then I would expect that number to start going down if the Fed cuts rates and it's at or near the inflation rate. So if we get Fed funds rate at a 3.25, 3%, and it's like barely pacing inflation, I would look for that number to deflate. If it deflates a lot, I think it stays a bull market. If it still holds up, if that cash balance is still really, really high, even with a sort of neutral return, inflation adjusted neutral return, then I would say it's more from people being concerned about the state of the economy.
Yeah, it's fascinating and it's such a weird time when, we've had 2 straight years of 20% plus return in the S&P and we're above 10% so far this year. I just said I thought, we're going to get another 6.5% by the end of the year, which would put us close to 20% again. And yet there's all this money on the sidelines and there's all these sectors that aren't benefiting. Yeah. And that's why when it's so AI driven that, you know, that's what we're talking when we talk about a bubble bursting. I wasn't old enough or even involved, knew anything about investing when I was in my teenage years in the late 90s when, we were hurtling towards, at least now we know, hurtling towards the dot-com bubble bursting, but I wonder how that felt compared to this with AI. I don't know.
Yeah,
So that's a great. We haven't given out our email address in a while. If anyone who remembers that and how wants to compare how this feels to pre-dot-com bubble bursting late 90s to the turn of the century, email us at streetcheck@cabotwealth.com. Is that right?
yep.
Streetcheck@cabotwealth.com. Please send emails. Yeah.
Common pushback that I've seen for people that like say, "Oh, this is just like the dot com bubble," which you are not doing. But that is the pushback that I've seen is like, well, the dot com bubble, you had a ton of no revenue,
Yeah.
no
Yeah.
earnings companies that were also getting run up. But obviously, I think we probably learned our lesson, or the market learned its lesson, because now it's only companies that are already making a ton of money. But you've just had a really narrow rally. Mag
Oh,
7 is 60% of the rally since the pandemic, I believe.
yeah.
I'm not sure if it goes back exactly that far, maybe back to the bear market lows.
Yeah.
Uh,
Yeah, I guess now saying that it's been such a thin rally driven by, you know, these oligarch type companies, sort of a metaphor for America right now. Um, that we're saying that it's not spreading to these, yeah, no revenue type companies that ran up well beyond any, reasonable valuation right before the dot-com bubble. Um, okay, our last subject is totally off everything we've been talking about today. Just thought it'd be a fun thing to talk about. Professional sports teams that you can invest in. Most of them, actually, none of them are really a truly pure play. The Braves, Atlanta Braves, are the closest thing, but as you pointed out, Brad, they own part of it is the real estate around the stadium, I believe, right?
yeah, the Battery Atlanta.
Yeah. And that is BATRA. We're just curious if winning has much of an impact on the actual stock price. The Braves stink this year. They've been good for years. But the stock's up 12%. Now that maybe just in line with the market is normal. Stock peaked in 2023, which incidentally was this summer 2023 when they won over 100 games. They did not win the World Series that year. They won in 2021. That sort of came out of nowhere. The stock that year was down for the year. So I was trying to find a parallel between winning and stock performance among the few publicly traded companies that major professional sports teams are part of their holdings. Now, those include Rogers Communication, Canadian-based telecom company that owns the Raptors, NBA team, the Maple Leafs, and the Blue Jays. That's up 17.5% this year. Blue Jays are having a really good year, but mixed bag with the other teams. And then MSG, Madison Square Garden, MSGS is the ticker symbol, owns the Knicks and Rangers. That is down 6.5% this year, despite the Knicks making the conference finals this year. You had numbers that went out like a decade, but I mean, you can give some of those numbers. Did you find any parallel between winning and stock performance?
I don't think so.
Yeah.
So, Comcast, CMCSA owns the Flyers. That's up 20% in the last decade. I don't watch enough hockey to know how consistently good the Flyers have been. It's been a few years, I think, since they
When you
were
think Comcast, you don't really think
Crosby.
Flyers.
Exactly. I mean, that's
Yeah.
the other element is like
MSG,
Comcast.
you think Knicks and Rangers playing there. Even Rogers is like so ever present in those stadiums, those Canadian or those Toronto-based stadiums that you kind of know, even as Americans, that those are pretty intertwined, and the Braves are its own thing. But yeah, Comcast, like the Flyers, are almost incidental to Comcast.
Yeah, and Rogers is a good sort of case in point. They're up 2% in the last 10 years.
Yeah.
Madison Square Garden, MSGS, up 77% in the last decade. That's been the best performer. The other one that I saw was Man U. So that's actually kind of a pure play on Manchester
Mhm.
United. They're down 7% in the last decade. Uh,
Hasn't
I
Man
don't
U
know.
not been great the last decade?
I have no idea. I
I think they used to be, and like, if I could be totally wrong on that.
I watch a little bit of soccer around the World Cup, and that's about it. And then inevitably, I'm like, no, I'm gonna start following soccer. And then I watch like Tottenham Hotspurs. I'll watch like one game at like 6 a.m. on a Saturday morning or whatever. And it's
Yeah.
like, no, no, I'm not gonna. I really like the World Cup, but other than
Oh, I
that,
love it. Yeah.
but really, there's not a. The difficulty is these are all like communication companies, um, and real estate companies predominantly. So they don't see it doesn't seem like the quality of the teams that they own really, really impacts the valuation. There's probably like a money velocity factor to it as well. You
Hmm.
know, the publicly or the sports teams, right? They trade hands once every 20, 30 years. It's pretty rare for an ownership group to sell its stake. Um, I mean, if you think like across all the major sports, like the Suns got sold kind of recently. Um,
Yeah,
who else
valuations
just
of sports teams are undeniably going up. Celtics were
yeah,
six billion, over 6 billion. What did the
and
Lakers? The Lakers just get sold, or they're on? I think they just got sold, right?
yeah, I think Bus just sold them. Um, and like the Cowboys famously are always their valuations always rising a ton.
Lakers were
Comcast is a
10 billion, 10 billion record.
yeah, Comcast is a $122 billion company. If the Philly Flyers are worth 2.3 billion and then they re-rate it to 3.1, it doesn't
Mhm.
really move the needle for
Right.
Comcast.
Yeah.
Man U is, let's see, a $2.8 billion company. So I'm guessing that is probably an accurate reflection of the value of the company as a whole.
Yeah.
Um, but I don't think if these were changing hands more frequently, maybe the winning and losing would matter. But the people that are buying these companies mostly aren't buying them because they're like perpetual winners. Um, they're buying them because it's the first team that's available, and then they're going to try and move them if they have to.
Right. And I mean, I think some of the most famous losing franchises, this sort of negates our argument. Like the Red Sox became probably even more famous the longer their Curse of the Bambino drought went on, 86 years. I think they were probably more popular and moved the needle more just nationally before that than since they've won their titles. Cubs, same thing, breaking their 100+ year drought. Um, Maple Leafs are probably them and the Montreal Canadiens are probably the two most popular NHL teams. The Maple Leafs haven't even been to a Stanley Cup final since the early 90s. Knicks. Knicks are one of the most popular teams. Now, granted, they're New York, but
Yeah,
they're one of the more popular teams. They haven't won since the early 70s. Um, so yeah, I think the winning in popularity. You mentioned your Cowboys are another huge one. They're the most popular, arguably the most popular American
America's
sports
team.
franchise, and
Yeah,
they have not been good. They haven't been to a Super Bowl since the mid 90s. Um, so that popularity and winning aren't synonymous, and then therefore neither would share price and of the few publicly traded sports teams and winning. I mean, I think the point you hit on about these valuations, sports teams going way up. Lakers $10 billion, Celtics over $6 billion. What if Jerry Jones ever sold the Cowboys? He probably won't. But imagine what that would go for. I think that's why people want to own these sports teams. They want the prestige, and winning is like it would be great, but it's more of a
yeah.
side perk.
It's like the mega yacht, right? Where it's like it doesn't matter how good you're like it matters a little bit, but it only matters in how you compare with the other 31 guys that own a sports team.
Hmm.
It's a marker of I'm drawing a blank on that word. Prestige.
Yeah, prestige. Yeah, status.
I
Yeah, like a lot of people know who owns the sports team. Certainly the biggest name owners. Like everyone knows Jerry Jones. Everyone knows. Steve Cohen now, who owns the Mets. I guess Steve Ballmer, people probably already knew before he bought the Clippers. But Mark Cuban. No one knows him without, not no one, but he wouldn't be half as popular if he hadn't known the Mavericks and running on the court every time he disagreed with the ref or whatever.
Yeah.
Um, yeah,
Yeah, I wouldn't know Ishbia if he didn't own the Suns. He's
right,
just a mortgage billionaire.
right. Yeah, I did not know him before he bought the Suns. Now I just know him as a really bad owner. But you guys are familiar with that in Phoenix.
Yeah, that's like a low bar to clear, but that's a requirement. You have to be a terrible owner to buy an Arizona sports team, or
Uh,
to shuffle one off to Utah, right? Like the
yeah.
Coyotes.
What is that team now? Utah Crack? Is it? No, it's Seattle Kraken. Utah.
I don't know. They
I gotta look
might.
the you vamp. I gotta look this up.
So I want to wrap up with one other thing that I think
Mammoth.
Mammoth. That's
Utah
right.
Mammoth.
That's terrible.
Oh, they have a
Um,
game. They have a game, preseason game in a week.
I
It's
won't
Mammoth.
go.
Yeah,
I don't have a team anymore.
I know. Yeah, too
Uh,
bad.
I want to bring up one other, since we're talking like high profile public events and stuff like that. I did happen to look at Sphere Entertainment.
Mhm.
That is the company behind the Vegas Sphere. They're up 45% in the last month. Um, and the reason that it was on my radar, obviously, we're talking about like sports teams that also own arenas and things like that. But you have had a pretty good hit rate on finding like post-COVID recovery plays.
Mhm.
Do you have any interest in Sphere? Right now, it is hosting a spherified version of The Wizard of Oz. Supposedly, it's pulling in like 600 grand a day. Um, I don't know if I don't know how popular that show is in Vegas, which is suffering a decline in tourism, to justify a 45% run up in the stock in the last month and a 76% run up in the last 6 months. But do you think that there is a post-COVID public event play out there? Maybe you're
Let me
what,
look at
TikTok
the
or whatever.
SPHR. SPHR, right?
Yeah, SPHR.
All right. So came public April 2020. Um,
Bad
peaked
timing.
at what's that?
Bad timing.
I know. Um, around 50 in February 2021, way down. Same, got back to around the same level early last year, and yeah, didn't break above that level until this month, really. Um, yeah, let's see. It was as high as 48 beginning of this year and just broke above that. Yeah, literally this month. Um, I don't know. Breakouts, just from a technical perspective, you like to see breakouts like that, especially after multi years, breaking through multiple years of resistance. I guess I don't know enough about, you know, how they're faring in terms of, I'd have to look into it in terms of, you know, are their sales growing? So my premise is the ones that the beaten down beaten down by COVID companies that I invested in. There's United Airlines, and then it was um, help me.
One of
I
the
won't give
cruise
away the one I
operators.
admits to a movie theater stock now, but there was a second
There
one.
was a cruise operator.
Carnival. Carnival.
Yeah, I wasn't sure if you
Um,
were giving the name away.
the premise was that have returned to record sales. Like they're doing better. Both companies were doing better than they'd ever done. And actually both industries were doing better than they'd ever done, but their stock prices were way below pre-COVID levels. So Sphere is a little trickier because it came public right at the beginning of COVID. I'd have to look at how their
I,
sales are faring.
I think that is I think that's the takeaway is they're still trading at pre-COVID levels. I pulled Live Nation. They own Ticketmaster.
Mhm.
Um, they are trading at all-time highs. They're up 205% in the last 5 years, and they are trading at uh, 2.5 times their pre-COVID price. So it seems like there is not a value play for the sports and entertainment investments. It seems like these companies are all trading at all-time highs, all well
Yeah.
above their pre-COVID highs. It doesn't seem like there's a value opportunity there.
Yeah. Yeah, that's interesting. 45% is nothing to sneeze at though. So yeah, I'll look into it a little bit more. Okay, so it's about time to sign off. Before we do, I just want to tell you about our offer today, which is near and dear to my heart. We're offering my Cabot Stock of the Week service for half the normal price. If you go to cabotwealth.com/street, that's Cabot Stock of the Week, which is a new stock every week that's handpicked from one of our 8 other investment advisories. So it sort of already has a stamp of approval by one of our other analysts, offering for $747 for the year against 50% off the normal price, 30-day money, 100% money back guarantee. If you want to try it out, see if it's for you. During those 30 days, you get at least 4 stocks. It's one every week. Um, and if you sign up, you get a free special report, how to be a successful investor for life, and email access to me. And like I said, there's an issue every week, every Monday. So again, go to kevinwealth.com/street to get half off of my stock of the week service. Any final words before we sign off? We've said a lot. What does Howard Stern always say? You said it all when he's ready for his guest to leave.
Never listened to Howard Stern.
Oh
Not a
man.
Howard Stern guy.
He's softened over the years. He's
I
he's
mean,
more of a human being now.
I have listened to him. I saw the movie they made, but I'm not a Stern listener. I think it's an East Coast thing.
It probably is. Yeah.
Brad's more of a Dallas Cowboy cheerleader documentary watcher.
Yep. Yeah. Let's see. You
That
you you in reality. When I think of reality TV, I think of you.
I I watched the first season of Survivor when I was in like high school and was profoundly disappointed that it was not like the reality show Alone, where it's
I
actually
love
like
that. I
survive.
love that show. That's one of the few that I
That,
watched. Yeah.
that's what I thought Survivor was going to be
Yeah.
30 years ago or 25 years ago. Turned it off and haven't really turned on reality TV since. I did watch the Beast Games show
So
with
you
my
don't
wife
watch
and
Alone.
daughter.
You admire Alone, but don't watch it.
Yeah, I admire it. I've watched a season or two, but I don't have cable either, and I think that's the I don't like I don't, there's
Yeah,
too much
that's
stuff
one that
streaming.
probably isn't, on a streamer because who knows how popular it is.
I had
Maybe
to
it is.
watch it on my phone when I have watched it in the past, I think on like the AMC website or whatever. But
Yeah.
no, reality TV, I have enough reality in my real life. I don't need it on my TV as well.
Chris, you said Alone is one of the few that you watch. Are there any other ones that you would like to share with our listeners that you watch?
Not really. If you want to share them, you can.
Interesting.
But
No, I'll save it.
So
all right,
no,
we'll save it for
nobody in
another time.
paradise or
That's all the time we have. We run out of time. Look at the time.
Imagine that.
this was a long one, so
It was a very long one. We got to get out of here. We'll talk reality TV again more next week. Thanks for joining us this week, and we'll see you next week on the next episode of Street Check.